Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So I apologize if you can hear the rain outside or the lighting's not that good or whatever, but I've just finished watching about 4 hours or so of the 2020 Berkshire Hathaway annual meeting, and I want to give you my thoughts on all the main things that were covered while it's kind of fresh in my head. So if you don't want to sit through the full 4.5 hours, this is my kind of quick summary of all of the main points that came out, and I hope you enjoy. So let's get into it. So the first thing I'll say is that this Berkshire Hathaway annual meeting has been very different from other annual meetings. You can go back and watch these right back from around 1994. They started recording these annual meetings, and every year it's a massive event. It's basically like a big expo of all the different Berkshire Hathaway businesses, and it's much more than your kind of typical shareholder meeting. So the vast majority of it is always a Q&A session with typically Warren Buffett and Charlie Munger, and it was a little bit different this time around. So obviously there's a large crisis going on in the world at the moment, which means a lot of people cannot gather in one place, and that meant that the format for this meeting was quite different. So instead of having Warren and Charlie talking to a massive crowd in an arena, we literally had Warren and Greg Abel, who I'll talk about in a sec, doing everything just over live stream. There was just kind of the essential people to run that live stream actually at the venue, and all the questions were done online. And questions that were sent in were asked by Becky Quick from CNBC, who many of you will know from previous Warren Buffett interviews. So we didn't have Charlie there. They basically didn't think it was worth him flying out. Now that he's 96 years old, it wasn't worth the health risk essentially with everything going on. But we did get to have Greg Abel there, which is great. So Greg has for a long time been one of the main candidates to sort of take over the running of Berkshire Hathaway, or at least the running of the operational businesses once Warren and Charlie is gone. And he has been the chairman of sort of the non-insurance subsidiaries within Berkshire Hathaway for a number of years. So it was great to finally get some questions that could be directed straight at him. And that was one of the main kind of benefits that came out of this meeting. So that's a bit of background on the meeting itself and what was kind of different than usual. Let's get into some of the main points that I'm sure you're all keen to hear. Now I'm going to be referencing some notes because I took plenty. The meeting went for a long time, so I'm glad I did. So the meeting started out, Warren basically went on like an hour 15, hour and a half like monologue just by himself before they actually got into the Q&A, and he covered a lot of topics and gave his kind of perspective of everything that's going on in the world at the moment and the way he is sort of thinking about it. So the main points that came out is that there's still a lot that's unknown. He really didn't have anything to add on the health side of what's currently going on. He did obviously have some opinions on the economic side, but there's still a lot of possibilities of how this can sort of play out. But he is very convinced that America will come out the other side of this and grow to become stronger than ever. He gave examples of World War II, 9/11, the 2008 global recession, and came to the conclusion that nothing can stop America, and you should never, ever, ever bet against America. So if you've got a long-term perspective, you're going to be fine in the opinion of Warren Buffett in terms of your investments. Again, every time he talks about this kind of stuff, his disclaimer is not that he thinks today is the perfect time to buy stocks, or the market's going to be up next month or next year or anything like that. But over a 10 or 20 year time horizon, if you're betting on America through something like an S&P 500 index fund, you're going to do perfectly fine, and you're almost certainly going to do better than a bond investment in something like a US government treasury bill that's returning 2%. If you're only earning 2% over an extended period of time, and inflation is also 2%, which is literally the target of the Federal Reserve in the States, you're not going anywhere. So that's a pretty low benchmark for stocks to have to outperform, and that is almost a certainty as far as Warren Buffett is concerned over the long term. Now, another couple of points that he made is that America still has a lot of growing to do and a lot of potential. The country is very young, and I'll put up a photo that I sort of took of my screen here comparing the age of America against the combined age of Warren and Charlie, and you'll see that there's not that much difference in it. And things have changed a lot in still relatively recent times if you're looking at kind of the overall history of the country. So the country is about 5,000 times more wealthy in real terms than it was in 1790 when the country was first getting going. And it's not all that long ago that we actually started to really unlock the potential of 50% of the country. It's not that long since, in the grand scheme of things, women have been able to vote and have been commonplace in the economy and in the workforce. So there's still a lot of relatively recent tailwinds to help push America forward. And he's extremely optimistic, always has been extremely optimistic, and that is completely unchanged on where America is going in the future. Now, all that said, he did have a couple of warnings for investors. So one of the things he said, like I've already mentioned, is he doesn't know what the stock market will do next week or next month or next year. And that's one of the reasons why you should never invest with borrowed money. He brought up the example of Berkshire Hathaway itself. There's been around 3 times in the history of Berkshire Hathaway since Buffett has been managing it that the stock has fallen more than 50% or has fallen at least 50%. And in each one of those scenarios, you would have been perfectly fine. You would have been extremely wealthy, in fact, had you held a substantial amount of Berkshire Hathaway stock in your portfolio and continued to hold it over those periods of time. But where you would have gotten into trouble is if you were purchasing on margin, if you were forced to sell at those low prices because you were trading on margin, you were borrowing money to buy stocks. And he's even had that happen to one of his friends, close friends, Rick Guerin, back in the 70s. Sold Berkshire Hathaway at a ridiculously low price because he was forced to with margin calls. And if you're someone that's going to get caught up in the psychological kind of hard times that often come with stock market investing, he basically said that a lot of people simply aren't fit to own stocks. If you're someone that is going to feel poorer simply because your stocks go down 20 or 30 or 40%, you're probably not fit to be an investor in individual companies, and you're far better off buying something like an S&P 500 and never looking at it again. Warren Buffett mentioned that if his stocks go down 20 or 30 or 40%, he doesn't feel any poorer. It's the performance of the business that he focuses on, because that's what will drive returns over the long term. So those were my main takeaways from Buffett's monologue to start off the meeting. After that, he spent a little bit of time going into some of the actual operating results for Berkshire Hathaway. And some of the main things that I want to talk about specifically are the operating businesses and also the investment side of Berkshire Hathaway and what's happening with that part of the business. So in terms of the operating businesses, they were actually performing very well. And in terms of operating income, they were performing very, very well in the first quarter right up until March, when what's happening out there in the world started kind of to take effect. So they still don't know the true impact, obviously, of what's going to happen moving forward, but that did have some impact in March. And we also have to remember that this is just the first quarter results. So this just includes January, February, March. We don't have quarterly reports for April kind of moving forward with Berkshire just yet. Now, one of the things that is interesting, though, is that Buffett did actually share the buying and selling of stocks that he's been doing in the month of April, which he has no obligation to do, but he wanted to give shareholders an idea of what's happening. And in April, interestingly enough, Berkshire Hathaway was actually a net seller of stocks, and that is very unusual. It would be more unusual if it was over an extended period of time, like if they were net sellers over a year or 2 years. Within a given month, possibly not so much of a surprise if you've been following what's been happening with airline stocks recently. So Buffett brought up the fact that there was some news made available that he's been selling shares in his airlines because he has gone under 10% ownership in many of those businesses. And he basically fully disclosed that he's completely out of all of the airline stocks, doesn't own a single share in any of them anymore. And he sort of laid out his reasons why. So in terms of airlines, his initial investment thesis was basically, this is a probabilities kind of bet that over the long term, the earning streams that we expect to get from owning a percentage of those airline businesses looks attractive relative to the price that we have to pay for those airlines. Now, recent months have changed that investment thesis and will impact airlines quite significantly, as many of you will know. Revenues have gone to close to zero for a lot of these companies. They're raising a lot of debt, and they're also raising a lot of equity and diluting shareholders in some cases as well. So in terms of investment, Buffett is just simply very uncertain on where those companies are heading, at least in the short to medium term. And the fact that they're going to experience quite a lot of pain over that period of time means that there's risk of those businesses going to zero. And it also means that even if they don't go to zero, they're going to have a lot more debt to service. Equity shareholders are potentially going to be diluted from capital raising. And there's probably going to be less people flying, which means that prices for airline tickets for getting a seat on a plane are likely to go down, which are obviously not a great thing for the airline businesses. So that's his basic thesis on what's happening with airlines. He sold at a loss, but he still felt that was a prudent thing to do for Berkshire shareholders. Now, one of the other things that came up in the Berkshire Hathaway quarterly report is that they currently have $137 billion in cash and cash equivalents, so short-term investments, short-term bond investments, that kind of thing, which is, again, a record. They've been setting records in this category for years at this point, and there's no change, and that's very interesting for this quarter specifically, because we've had one of the fastest price drops in stock market history over these last couple of months. So it showed that Buffett still is not finding many opportunities, didn't put very much money at all to work. I think it was somewhere in the range of about $400 or $500 million, which is basically zero in terms of the scale of Berkshire Hathaway. So very interesting. He was asked about that a few times. He hasn't put much money to work in stock market investments or acquiring new businesses, just because there aren't opportunities there, in his opinion, even with the price fluctuations that we've seen. And he also mentioned that they haven't offered money in terms of helping to bail out companies and giving cash to businesses in distressed situations, which is something that they've got a pretty good reputation for being able to do and get good interest rates on sort of corporate debt. And the reason for that, again, is basically the opportunities just haven't been there. They've seen the Federal Reserve step in that department, and basically just about any business has been able to borrow money still at reasonably low rates, and they've had calls from businesses that had needed money, but most of them have been able to raise it in public markets, and the opportunities simply weren't attractive enough for Berkshire to go down that track. So the results of all of that is basically the cash pile continues to build. If market prices keep trending up as they have done over the past few weeks and month or so, that cash pile will probably continue to grow. If prices come down, hopefully that cash pile gets put to work, because that is going to be a good thing for Berkshire Hathaway shareholders long term. If you've just got a bunch of cash there earning 1 or 2% a year, it's going to drag down your returns over the long term. But Buffett holding that cash tells me that he clearly thinks it's worth the opportunity cost, and he thinks he's going to get some sort of opportunity to put money to work at attractive rates sometime in the hopefully near future. Now, the last thing that I want to do is talk through a few of the Q&A questions and points that I found interesting that came out. Many of these are going to be completely unrelated to each other, but I kind of just want to talk through each of them that I've got listed here. So Warren mentioned that many of their smaller businesses and more cyclical businesses and more seasonal businesses have been struggling. So he brought up the example of See's Candy. See's Candy basically loses money for most of the year. And when they have things like Easter or like Christmas, they sell a lot of candy, a lot of chocolate, and they're very profitable during those months. And when you balance all that out over an entire year, they are a money printing machine, basically. So the timing of what's been happening in recent months has been pretty rough for See's Candy. So they have actually got a lot of inventory kind of stored up at the moment. They've made a lot of chocolate, and they've been struggling to sell it, essentially. So there's a few businesses that they own that sort of fall into that camp. He did mention the main ones that are struggling. See's Candy is an exception to what I'm about to say, but the businesses that have been struggling the most, when they look at them rationally, they really are businesses that were struggling to at least a certain extent, even when business times were very good. So it sort of sped up the decline process for some of the poorer businesses that they own. But the large businesses, Berkshire Hathaway Energy, insurance, and so on, they will be perfectly fine. And even in worst case scenario situations, Berkshire Hathaway is still going to produce cash and will still be cash flow positive, as Buffett will put it. Now, obviously, insurance is one of the main businesses for Berkshire Hathaway, and more specifically, auto insurance, insuring cars through their business Geico. And one of the interesting questions that came up was, is 2020 going to be a extraordinarily profitable year for Geico, because there's less people on the roads, and in theory you'd think less people claiming insurance because of car crashes and so on. Interestingly, Geico has actually offered to credit a lot of that insurance premium back to the customers this year, so they probably won't be that much more profitable than usual. They probably will be to some extent, but that was a move for them to retain customers as much as possible and sort of preserve the moat of Geico moving out of this situation. Next question that came up that I found interesting was from a long-time Berkshire Hathaway shareholder who basically brought up the fact that, to be quite blunt, Berkshire Hathaway has not beaten the S&P 500 index over the past 5 or 10 or 15 years, for that matter. And he wanted to get Buffett's thoughts on whether Berkshire will outperform in the future. And Buffett basically said he would not bet his life on Berkshire Hathaway outperforming the market in the future. So he thinks they will do quite well. He thinks they'll still offer good returns, but it won't be anywhere near what they've done in the past. And that's simply the law of large numbers. Nobody in the world can compound the amount of money that Berkshire are working with now at high rates, like 20%, like Buffett has done in the past. So the returns are basically guaranteed to be lower in future, but he still thinks they should do quite well. And one of the things that has influenced the returns been slightly lagging in recent years is that we've had a massive bull run in the stock market. So if you look at the absolute returns on Berkshire stock, they've still been quite good. It's just when you compare it to the S&P 500 that's just been roaring up for a decade, that's when they don't look quite as flash. And that's pretty much to be expected with Berkshire. I think in down markets, they will have businesses that continue to be very profitable and that will help them outperform through down markets. And the more massive fluctuations we have in stocks, the more that Buffett can use his skill to put money to work. And that's where they get a lot of alpha, a lot of outperformance is from putting money to work at really intelligent times when other people are quite scared to, basically. Now, two final things I want to cover. So the first one is a question Buffett got around share buybacks. We saw that Buffett bought back a little bit of Berkshire Hathaway stock over the last couple of quarters, but he really didn't buy much at all in the first quarter of 2020 just gone. And he got a question on why that was the case. Berkshire Hathaway stock is down from prices where he's bought it in the past, and this particular shareholder wanted to know why they didn't purchase more shares. Surely it would make more sense to buy in more stock if you thought it made sense at a higher price. And Buffett sort of had two answers to that. So the first one is he doesn't believe the price is significantly different to where they purchased it. He doesn't think it's twice as attractive because it's down 50% or anything like that. It was down as much as 30% from where it had been bought in the past at one point there, but it's bounced back a little bit and it's not down as much as it might look on the face of things. So that was the first point. And the second point is that intrinsic value changes. So Berkshire Hathaway is worth less, not worthless, but worth less than it was a few months ago. So they've had permanent losses of capital in the airline investments. They've had a few things kind of go the way that they wouldn't want them to go. So the discount to intrinsic value, if intrinsic value has also come down slightly, is not super significant. So it didn't make a whole lot of sense for Buffett to kind of put that money to work in share buybacks, he still thinks it's worth just holding on to cash and waiting for bigger and better opportunities should they come along. So that was share buybacks. The final thing that they sort of, I think this was the second to last question that they got in the meeting, and this is the final thing that I want to mention, is Buffett sort of mentioned earlier in the meeting that Ben Graham is one of the 3 smartest people that he's ever met. If you don't know Ben Graham, he is the author of this book, The Intelligent Investor, the Bible of Value Investing, and one of Buffett's longtime teachers, and the guy who sort of formed his investment philosophy. So someone actually picked up on that comment and basically asked if Ben Graham was one of the 3, who were the other 2? And Buffett sort of said that he's intelligent enough not to know not to answer that question for risk of offending anyone. So he didn't reveal the other 2. If I had to guess, I would say it's Charlie Munger and Ajit Jain, but that's just my personal opinion. But one thing he did go on to mention around that is that IQ points and wisdom are not necessarily correlated and are not always in kind of a linear relationship. So the smarter you are in terms of IQ points, that doesn't necessarily mean that you're going to be wiser and a better investor or a better business partner or anything like that. So that was a nice thing to hear, and that gives me personally hope, because I certainly don't have the highest IQ in the world. So those are my thoughts on the Berkshire Hathaway annual meeting, and I'd love to hear it from you if there's anything you think I've missed that you really got out of it as well. But for me, it was another very good meeting. I think it's one that a lot of people needed and will benefit from, just to kind of get all the gunk off the windshield of the car as you're kind of driving down this investment pathway, and have clear thoughts and take a long-term view. So I enjoyed it. If you enjoyed this video summary, please hit like and subscribe. You can watch some older videos over there. Hit subscribe over there. Love to hear your thoughts on the meeting as well, so drop them as a comment. Otherwise, I will see you in the next one. Cheers.